Bond market sending the all-clear signal in Europe. Time for a little insight and action. Let me show you what we're talking about. Take a look at the Spanish 10-year, and you will see that we have fallen on the yield down to 2.5-year lows. In other words, you had all that angst as people sold bonds, pushing the yield up. Well, look what's happened. It's come all the way back to where we were 2 years ago. All that fear coming out of the market. That's Spain. Take a look at Italy. A very similar story. All right, all that fear took us up, and now the fear is falling, which means bond yields coming down, and we're back to where we were. Look at this, pre-crisis in Italy. So the bond market telling us, hey, wait a minute, it's not so bad. We're back to where we were in 05, 06. It gets even more poignant when you add in Germany, which is considered the risk-free place to go in Europe. Look what happened back in the 2004, 2005, 2006. Italy, Spain, and Germany all trading hand in hand. And then look what happened as they split up. People went into the safety of Germany. They fled, and that's what drove those yields higher in Spain and Italy. The question is Europe reunited? And the team over at Ned Davis Research says, yes, the fact is, in fact, there is plenty of room for these rates to converge and come down towards German rates. They're not saying at Ned Davis that you're going to see a 1.4% rate in Italy or Spain. They're just saying that that spread is going to narrow, perhaps to what it looked like back before the crisis got so bad. Unless there be any doubt, just take a look at what happened today. Never before has this happened. Microsoft issuing bonds in Europe, making the jump over to Europe, issuing 550 million euros of bonds. The point being, if Microsoft, an American company that has plenty of cash and doesn't need to issue bonds, is willing to go to Europe, maybe that's a signal for the rest of us to do the same.